Hello everyone, my name is Dan Ozaki with First Financial Security. Today I want to talk about the difference between term and permanent insurance. I've been reviewing a lot of clients' policies lately, and people don't understand the difference between purchasing a term insurance policy or purchasing permanent insurance. They just see that permanent insurance costs them more money right now. In actuality, term insurance is going to cost you a lot more in the future. Let me explain why. Term insurance is basically like renting a house. You actually make the payment on the house, but you never actually own the house. And after a period of 15, 20, or 30 years with a life insurance policy, you end up with no life insurance, and the insurance company keeps all the money. The problem happens is when you try to renew the policy 30 years later, you might not qualify health-wise, and I guarantee you the payment's going to be 30 or 40, even 50 times higher than you originally paid. Let's talk about permanent insurance. Permanent insurance is more like purchasing a house. The cost of the monthly payment is higher, but after 15, 20, 30 years, you actually own the house. Same thing with permanent insurance. You actually own the insurance policy, and it goes all the way till typically age 120. So what we found is the cost of insurance for permanent in the beginning might cost you more, but after about 15 to 20 years, you could actually stop paying on your permanent insurance policy. It will continue to age 120, and it will guarantee to pay you out whatever the face amount is that you originally purchased. Typically, when we do the calculations on a permanent policy, even at the worst case scenario, after the client has paid up the insurance policy, usually they'll get at least minimum double the money that they actually invested in the policy. Let me give you an example. If you purchased a $100,000 policy, let's just say you paid into the policy for 20 years and it cost you $40,000. At that point in time, you stopped paying on the policy. It went all the way to age 120. At the worst case scenario for most clients, it would still pay out double their money. So you invest $40,000 in the policy. If you had a $100,000 face amount, you would get double return on your money. On the flip side, the term insurance policy, it might cost you for the same face amount, $100,000 face amount, because it's only for 30 years, it might cost you a lot less, maybe $20,000. But at the end of 30 years, you lose the $20,000, and then you end up with no life insurance. If you try to renew the policy after 30 years, it might cost you 30, 40, 50 times more money. A lot of the clients that I have actually took their term policies out to 30 years. They just recently expired. They didn't realize that the policy was going to be that much more expensive, and now at this point in time they can't afford to renew the policy because it's way too expensive, and some of them don't even qualify health-wise. This is the reason why when you're taking a look at your life insurance policy, you got to make sure that you understand the policy correctly and the terms of the policy before you purchase it, or even if you have a policy, to review the policy to make sure that you have the correct type of life insurance. We recommend that you have permanent insurance as much as the client can afford, and then we offset the difference of more insurance that's needed with term to cover how much money you need as far as life insurance is concerned, and we correlate that with your budget. What I would suggest that you do is you review your policy with your life insurance agent, or you can give us a call, because that's what we do on a daily basis. We actually review your policy with you to make sure that you have the right type of life insurance policy for your age and for the time period. Again, my name is Dan Ozaki. I'd like to thank you for watching this video, informational video, with First Financial Security.